Good morning, sir.
Hello, Mahesh. How are you?
Fine, sir. How are
Good. Will the other students join in?
you? I don't know, sir.
Okay. You can put an alert in the WhatsApp group.
Yeah, I will.
Okay, students. So what did you make of the market action this week? Mahesh and Nidhi?
It was in sideways, sir.
Yeah, so as we discussed, I told you that the market will come back down. It broke above the 50-day moving average. So it came back down. and then it regained the 50-day moving average. So price action, I would say, is still bullish, right? So if it had closed below that blue line you see there, which is your 50-day moving average, then it would have been bearish for sure. It was looking, it may do that. It has come up. So Monday, another gap up opening is likely. So, but here is the point, right? If you go on the weekly moving average here, that middle level of 1655, that is where I think all kinds of resistance is. Short run, it may try to go there, but we'll have to watch. So my views are that the markets are still not out of the woods. So you have to be careful. If you're long, use a stop near the 50-day moving average or the 20-day. Price has tried to touch the 20-day middle Bollinger Band there and has bounced, and now is at the 50-day moving average, which typically is big resistance. But off late, the market is saying that maybe downside has been done for the short term. Maybe we can get a short-term rally. That is all well and good, but the problems we have are more from the currency side. The rupee briefly touched 80 this week for those of you who are following. Yeah, so it touched that. So now it may cool down a bit. So that is giving probably some support to the market. But commodity crash has continued. Yes, very big commodity crash has continued. Gold, copper, all these guys are crashing. So if you look at the gold chart, it is so when gold crashes like this, usually stock markets follow with a lag. So gold has just gone down, straight down, right? So this type of price action is saying that deflation is there. Deflation typically happens when big recessions come, and on a weekly basis, gold chart looks very scary actually. It broke a lot of support. My guess is it may touch that 1655 red line there, which it has not done in a long time. But this is pretty much scary here. The other culprit was this. Crude oil did a swan dive as well, crashing nearly 7% this week, again on recessionary fears. Yes. So in the US right now, you guys are hearing me, right? I'm audible, right?
Yes, sir.
Okay. Yes, sir.
So you guys know from fixed income, Kiran Bindu sir would have taught you about the yield curve and inverted yield curve and all that.
Yeah, we were taught about the yield curve.
Yes.
Yeah.
So if the yield curve inverts, which means short-term interest rates are greater than long-term interest rates, usually recessions come. And if you look, is at what is happening in the US. So 6 months down the line, I think you're going to get a recession. So here in the US market, yesterday the markets were all up. But if you go and look at the treasuries, you can see how the 1-year interest rate, yes, is almost equal to the 2-year, which is greater than the 5-year. 5-year is greater than the 10-year. And the 2-year interest rate is also greater than the 30-year interest rate. So this is telling yield curve is inverting, which means what? Probably a recession is coming. So short-term interest rates, as you can say, you can just compare the 1-year and the 30-year here, or the 2-year and the 30-year. 1-year interest rate is higher, just about higher than the 30-year interest rate. So why is that happening? Because people are not sure about the future. So when the yield curve inverts like this, you get a recession. So you would have seen this. So let us go to world government bonds. So if I look at inverted yield curve here, the Indian yield curve is also flattening. Next, it may invert. So if you look at inverted yield curves, look at all the countries. 10 countries have an inverted yield curve. America is almost inverting. Yes. That's few. I think, see, UK is also partially inverted. So these are all curves. Yield curves of many countries are inverting, and I think it's a warning sign. Look at Pakistan. Pakistan is inverted. Some of India doesn't come here. I don't know. So in the 10-year, Ukraine has inverted because of the war. Surely there will be a recession there. India is not. China is positive. You can see when the 10-year, 2-year interest rates are negative, that there is inversion. But you can see many countries are just about to invert very soon. Not that big a difference. And if you look at sovereign CDS, this will tell you default probabilities. And you can see probability of default, PD, is what it is. You can see that if you go down, Russia has defaulted already, so 100%. Sri Lanka also would be in this list, right? You can see some of the countries, anything that is greater than 2% has a chance that default may happen. And Brazil CDS has widened quite a bit, which is a big surprise. Turkey, not a surprise, but Italy. Italy is another country which is in danger of some kind of default in the near term. It's a good rated country, but they are having some problems and they may default. So I wouldn't say they would default, but I think there are some issues there. So the world's economies are very fragile. Inflation is high. Central banks are going very aggressive. The US CPI report came at above 9%. Right? So all these things are a problem. Okay, one more thing we discussed in last class is the alternative. There's a good platform called TradingView. It is much easier to make a portfolio in that one. In case you don't want this IQ option, you can join TradingView. It's very easy to create and track your stocks here. So you can go here. And there's a trading panel. So if I say, there is a trading panel here. So here you can actually track and manage your steps. Where would that panel be? Mahesh, you know where that panel is?
Sir, maybe it was in brokers.
Brokers, you think?
They should have paper trading.
Yeah. Paper somewhere here.
Sir, open any chart first.
Underneath it will come usually somewhere. Yeah, here it will come. Okay, click. If you go down, you'll see trading panel. Okay. So in this paper trading, just click connect paper trading. Yes, students, are you all seeing this?
Yes, sir.
You can trade anything here. In case you don't want to use that IQ option platform I gave you, you can use this. This will also track all those things. You just hit connect and you can buy and sell anything and it will track your trades as well. And they give you 100,000 balance. So no problem there. All right. Yeah.
Okay, sir. Yeah.
Yeah, so this is easier as well. So here you can also have a good log of all your trades. Some people were saying the IQ option thing was not working. So this is the best platform out there. Most platforms, even I think IQ option in default uses these guys. Okay, there we go. So you can look at a whole range of asset classes here. So dollar has been very strong of late. Cooled off on Friday, but very, very strong. And I think it is above some levels where I think it can really smash the exporters in the US, right? So guys who are exporting from the US, the big companies, they're all going to get hit by the strong dollar. The other thing is, despite all the rallies, you're seeing Bitcoin suffer quite a bit. It has not. You're seeing how Bitcoin is doing the exact same thing it has been doing all year. It crashes, then makes a narrow channel in the Bollinger Bands, and guess what? It's going to crash again. So if it hits the here, I think it may be as early as next week. The next time, I think it's going to give a very big, big crash, I think. So Bitcoin is something that is telling you that the world is not, easy money is not there anymore. So when easy money was there, things like Bitcoin were going up non-stop. But now Bitcoin from 65,000, I think, is down to 20,000. I'm thinking when all this ends, I think Bitcoin will be 5,000. So the risk in cryptocurrencies is huge. So I think you should stay away from speculative assets like crypto. Gold is actually a good investment long term, I think. But Nifty is looking good. Yes. You can see that downtrend line which we drew last week. The market tested it and bounced. First time it is bouncing above it. So my views are Nifty looks good in the short run. Now I will go and see what the market outlook is. Chavi, will you present on the stocks you bought or sold today? In the last hour, yes, no?
Sir, I am through my mobile. I'm joining the session through mobile phone because I am in office.
Oh,
so
okay.
I'm not in a position to share the screen.
Okay. So you can do it. You tell me when you will do it and then you can do it, but do it fast, yes?
Sorry?
You can do it whenever you are able to do it, but come prepared one day and do it.
Okay, sir. Sure.
Yeah, because there is a weightage of marks assigned to it. So that's why. So two of them have already finished. Nidhi and Mahesh have finished. I told the others who were here last week to be ready. So one of these days you have to do it. And the other trades we are going to use is through the option platform, which I will show you. Already last class, Mahesh, we did use Opstra Edge for some strategies, right?
Yes, sir.
So we will do more of that. today. But in the meanwhile, let us
Sir, there is under first video.
yes, what now?
A previous dashboard and there is a video, that's why.
Oh, is it? Okay. Let's see their latest. This is for July 15 only. But anyway, let's see what they said. Next video will come only Sunday night. So
SGX Nifty and Dow Jones and say, hey boss, आज तो Dow Jones गिरा तो कल ऊपर उठेगा. No, we do it with a certain method. We only look at that data which is available at 3:30 in the afternoon. So the objective is, if you watch this program for a while, I hope that you will learn how to make a call on where the market is likely to go at 3:30 on any trading day, right? Because that is what is important. So the objective of this program is what? We have to learn how can we make a trade at 3:30 looking at the data which is available to us at 3:30. Now there is some data which is not available, of course FII data, but the option chain is available, the charts are available. So we look at these things and we try to figure out what the market is likely to do. Again,
Sir, the
there is
screen is
no
not
point
visible.
in looking at
okay.
the charts. Sorry, there's no point in predicting what market will do at open tomorrow, right? Because uska aap kuch nahi kar sakte.
I have shared it.
Our idea is how will
Don't
we
know
react
why.
regardless of what market does tomorrow, right? So this is our objective. Chetan is saying speak in Hindi. भाई मेरे चेतन हमने एक अलग चैनल खोला आपके लिए, हिंदी चैनल. Why are you saying speak in Hindi, dude? Just watch Hindi channel. There's a Hindi channel. You can search on YouTube for, sensible Hindi and you can go there and watch it, right? So if you want the Hindi version of the same program, please watch Sensible Hindi. It's a brand new channel, so um, yep, that's that. So now that I'm done with promoting Sagar's lovely, bearded look, let's go back to the analysis, right? So first, let's start with Nifty chart. So largely it played out yesterday exactly what we thought of, right? Our analysis day before yesterday was that 16,000 is very unlikely to hold. I mean, on 12th we thought it might hold, but on 13th we were very clear that this is not a long market. 16,000 might not hold. Very difficult to go above 16,200. Yesterday we said that if you get an uptick, sell the call and be happy. And if you get bear put spread, get a good entry, do it. I mean, beautiful, right? Today you got an uptick, you got a bear put spread entry, you got everything. In fact, if you had done a 16,100, 16,000 call spread, sorry, a bear put spread on the open, you could have got a risk reward of slightly above 1 and probably made, like around decent profits were up for taking. And we were also talking about 15,850 will act as a resistance, sorry, support, because this line which we talked about here, today it went till that point, maybe slightly lower, but yeah, 16,850, yeah, was a day low actually. 16,856 I think was the day. I mean, whatever, right? Some 2 points either or the other, who cares? But largely Nifty is testing this line again. It has the bounce from there. It is below 50 DMA. It has confirmed the bearish engulfing on chart. It is very simple. So here's the thing, right? There are some short markets which are easy because uh, there is not much of a support there. It just goes like top and gone, right? There are some short markets which are difficult because there is going to be a lot of uh, support on the way down. This is a place where short is not very easy to play, because if you're shorting here, this entire zone, right? So there was a lot of consolidation in this entire zone. People sold, people bought, people sold, people bought. Now all the people who did that, they are going to again come here to support. So like the move from this to this, for example, was easy. This move, I don't know how easy it is going to be. There is a possibility that in this zone we'll get some buying interest, right? So if you're shorting, don't try to short with bought options, because this might not break easily. It might take some time. So I am happier shorting with futures or selling calls or something, simply because this is likely to be a whipsaw. And if you bought put options, yeah, it's not a nice idea, because it might not happen as fast as you expected it would happen, right? So That is point number one, right? So the market chart wise, it's a very clean market. This is looking bullish, sorry, bearish, but there's a lot of support coming, so it might not crash like we hope it will. I mean, I'm not hoping it will. It's just that we have position, and we are just thinking about position. Now, 16,000 is a major resistance according to option chain. So let's look at option chain also. This is 21st July option chain. Look at this, right? We don't see 35 to 40 lakh calls on day one usually, right? Like if you looked at it last week. So actually now we have open interest. So update, this chart now works for next week, even at the end of this week. Thanks to Asnim for that. Asnim is one of our earliest developers in Sensible. I think we hired him right out of college. He was very interested in joining us when he was in his final year in college. So this is around 2.5 million, right? And this is pretty huge for a day one. And if you look at this, this is around 4 million. That's also pretty big for day one, right? I have not seen 4 million calls on day one of an expiry often in the past. So usually I say कि boss ignore कर दो, day one है क्या ही देखना है. But this time there is some significant volumes here, right? That's point number one. And if you look at PCR, it's at 0.9, which means that it is not all that happy. It's mildly bearish. And if you look at FIA data, it is not nice because puts are more than calls overall. Today, of course, they bought some calls, massive call buying actually, 60,000 call buying. This is very bullish actually because they have 60,000 calls bought and 16,000 sold, but overall this is still a huge gap, right? Overall it's a huge gap. Yesterday we knew that there was this gap, so maybe like it seems like a huge gap ki 60,000 call kharida, but at the end of the day we have to realize that yesterday call OI was negative, which is like an unknown phenomenon, and now it has become like a tiny block. Or let me put it in perspective, right? The OI call to put ratio is pretty much the same as on 12th July as 14th July. I mean, 14th July is the same as 12th July, right? So, although this might make you think that this is bullish, overall this is negative, right? Now, again, index futures 600 crore stocks is like mid negative, not like 1000 crore negative, but it is 600 crore negative. Stocks 300 crores is hardly anything here. 300 crores is nothing, right? Mildly bullish, right? Open interest on futures is pretty much remained the same, so nothing there. So what's my Nifty view? Like I said, right, it's not a market which you can short with bought puts because there's going to be a lot of, I think it'll have some whipsaw, right? And I don't even know if this will break this zone because that is prediction, and we are not in the business of prediction. But yes, if this point breaks, this 15,850 breaks, we can see a move to 15,600 perhaps. And if that 15,600 breaks, maybe we can see further down move to 15,200 or something. I mean, so don't get me wrong. Overall, the trend is negative, right? Because we can draw this channel here. So I'm not saying that this is a bullish market. All I'm saying is that whatever you play the bear market with, the choice of instrument is critical. I mean, you can get lucky and market might just go ekdam dhadam se, but I don't do that. I mean, I'm so you can see this, right? The channel is very clear. The long-term channel is also clear. Short-term channel is also clear. Everything is screaming sell. And if you were to draw this line, so there's one more line you can draw. Sorry, I'm drawing too many lines, but if there is a line, we have to call it out, right? You can see this also, right? This is also now a line. And the fact that today there was a bounce confirms this, right? But if this line is broken, today's line is broken, then there will be a move to 15,600. And if that 15,600 also breaks, which it might or might not, we are not in prediction business. If you ask me, 70-30, I'm in favor of breaking and going down, right? Then we can see further downside, and I am not sure where that will end. It may be 14 something, but let's not get ahead of ourselves. We are not in the prediction business. But overall, you have to stay short with the right instrument. Probably a long-term call because there's a lot of premium in it, because that's what I would do. But that is Nifty read, right? Now let's go to Bank Nifty. Bank Nifty is also interesting. Okay, Bank Nifty is super interesting now. bearish engulf, bearish harami, we talked about it, confirmation and then further negative, and Bank Nifty is firmly now looking like it's coming down. And USDNR, yeah, USDNR again, right? Every day, why are we doing this thing? I mean, we might as well just say, auto buy, auto buy. So I'm really interested in knowing. Okay, so I have a honest confession to make. I did buy dollars somewhere around 75, 76 levels, but I exited everything when the future price of dollar was 79.12. So that's a very sad thing to do, to be very honest, because I missed like almost a rupee rally despite screaming every day, he was buy dollar, buy dollar. I sold off at 79.12. Simply because I wanted to free up some margin to do some nifty shots, but in retrospect, dollar was a better long than nifty was a short, right? So I did a wrong thing by moving to the wrong asset class and ditching the right trade. But dollar is looking firm. I mean, I don't know. The only thing which is really confusing me is where do we enter? It's not a short is very clear, but you can't chase momentum if you don't find a good entry and exit. So the question mark in dollar is not whether to buy or not, it is where to enter. So please watch for some kind of dip you can buy, or you can even buy with a tight stop loss and see where it goes, right? So let's say dollar some dips some 20 paisa and you see that there's an intraday candle suggesting some buy, then you can try longing dollar and maybe it might just go much more long, right? But this is a very strong dollar formation. This is crazy. I mean, I've not seen anything like this after 2013. Right, so dollar long, but we have one last part of our analysis left, which is um, weekend weekend candles, right? So week candles, because tomorrow is the week's close. Ayo, this is bad. This is a okay. I am seeing it now, which is why my expression. This is a bearish harami, right? And bearish harami is usually a reversal signal. Now let's look at Bank Nifty. Bank Nifty is also a bearish harami, right? I mean, this is both of them are bearish harami. Bank Nifty is a bearish harami, Nifty is a bearish harami. Let's look at dollar. Dollar kya hai? It will get a bullish baru bozo, right? Oh my God, look at this, right? Somebody who bought it here, if they had not exited here, they would have been long here. Sorry. I can't stop laughing at myself because of the stupidity I did. I don't know why I exited it. I got neurotic, but yeah. So Bank Nifty. So I'll just write that down also. So this is so now my bear signal is a little bit more bearish. Bank Nifty uh, and Nifty both forming bearish harami reversal patterns on weekly candles, right? So this is mega bearish, so this is bearish, so chart is bearish, daily time frame chart is bearish, weekly time frame option chain is bearish because 16,000 with this call. PCL is mildly bearish. FI option data overall net it is bearish, although bullish bias on a daily basis, but yeah, come on, like yesterday they had negative, right? So and then futures data is of course, so basically, right, this is not a time. So I think I'll answer one question which somebody asked, is this the time to build portfolio? Absolutely no. To be honest, I have three stocks in my entire portfolio. They're like three, one, two, not like three companies, three stocks, one, two, three. One stock of Vedanta, one stock of GMR. All of these were test trades. Like I think I emptied my portfolio, wrong emptying, of course. I emptied at some 14,000 or 13,500 on the way up, but that was very stupid also. It's like what do you say? Before economy reaches its peaks, I mean, stock market is often disconnected with economy, and then so experts like us are disconnected with both. I mean, which basically means we are not experts. So Shashi is asking a good question. Will the result of HDFC affect the market tomorrow? Now that question is out there, just out of curiosity, let's look at what HDFC ka chart is looking like, right? I might not have an opinion, but let's just do it for fun anyway. Huh. So, okay, purely technical. Of course, results are all events which can screw all sorts of technicals. This is a bearish engulfing candle which broke a 50 DMA line on a daily time frame. It's not generally a good sign. And HDFC Bank is below 200 weekly moving average on a weekly time frame, and this is so Yeah, like there is event, right? If there's no event, I would have said ki this is like a clear shot. But because there is event, I doubt. There's another possibility that whoever knows the event has already taken the positions to short, which is why the graph is looking like this. Will it affect, will HDFC results affect market tomorrow? Unless it's an extreme surprise on the upside. If market is generally negative, I don't think HDFC Bank can carry the market alone, right? Because in times of global panic or something, I don't know if there's a panic or not, it's not like HDFC can save it. So yeah. And largely Nifty is a river, stocks are boats. There's so much. Oh, this is not HDFC Bank. Sorry. Somebody said it is HDFC results. Yeah, my mistake. Okay. On weekly, this is okay. This is not that clear. This is not that clear. Yeah, this is not that clear because 50 DMA is a support. No, so I'll take everything I said back. Perhaps HDFC is still a good shot. I don't know, but bank is it is below 200 DMA, it is below 100 DMA, it is slightly above 50 DMA. If it breaks, it can trigger further downfall. But again, why gamble on events, right? There are so many other beautiful patterns we can trade, like Nifty, which has so much data points. Why go behind gambling, which is betting on an event? So I wouldn't want to do that. But HDFC will not be able to carry Nifty alone if everything else is um, you know down. So anyway, that is our analysis for today. Usual warnings, not disclaimer, not tips. Sorry, not usual disclaimer, not tips, not advice, not recommendations. Just analysis so that we can do this on our own at 3:30 without really doing this. So that's it from us today. We'll see you again on Sunday. Thank you guys so much for joining.
Okay, students. So what do you think? So he summarized a lot of things, right?
Yeah.
So basically he's saying he's also looking for a top. So, but the market is going to surprise everybody and go up in the Monday morning. The question is, so whether it will hold that, right? So the upper Bollinger will come into play. So I think my view is we may get an up move and it may find resistance. So the global market picture is like that, right? So here we are challenging it. The US market, this is again just a question of it making lower highs and lower lows. So if the US market may try, my guess is another 30 points, 1%. And if it doesn't hold, I think we could potentially have another lower Bollinger Band type scenario. All these risky assets are looking. So you can see how Bollinger Band widens, we have a consolidation, it narrows, and then it crashes. So this is no different, right? All these markets are looking very, very scary and similar. German market is here. The German market really got smashed this week. It bounced Friday, but again, they all are looking like very similar things. Nifty is no different. So here, look. 1,000 point, you have a big crash, 1,500, 1,600 point crash. Then you get a 2/3 retracement of that, 1,000 points up, and then a crash again. So this is, I don't see how this changes anything, but the short run, it is above support and above the declining trend line. So we should be open to the possibility of short-term upside, but globally the situation is deflationary, which means any rally can disappear very fast, quickly. So that is something we need to keep an eye out on. Okay. Any questions, students, on anything discussed up to now?
No, sir.
So this is the site we are going to be using. Please make a note of this. Your second assignment will be based on finding profitable option strategies using this Okay, all right. So in last class, we were talking about option strategies. Okay. Students, I'll just be back in a second. Give me 2 minutes.
ಬಂದೆ ಒಂದು ನಿಮಿಷ ಆಚೆ ಬರ್ತೀನಿ. చాలా బాగుంది ఫోన్. బాగా చెప్పింది. నేను ఎక్కడ 3 రోజులు చెప్తున్నాడు చెప్పిందా డిస్ప్లే చిన్నదే అదే వద్దులేండి ఎంత చేయించుకుని ఇయర్ ఫోన్ ఏం బాగుందా ఓసి వచ్చిందంట నాకు ఎక్కడ ఎంత మోసం నాకు యాక్చువల్లీ నాకు ఈ ఫోన్ ఏమైనా అతని ఈ ఫోన్ కవర్ ఉంది యాక్చువల్లీ ఈ ఫోన్ అంటే నా మొబైల్ ఎంత 18 పడింది 15 మొబైల్ 2000 ఎక్స్ట్రా ఇదే తీసుకోండి చిన్న 2000 ఇదే పసాలు అదే ఉంటుంది. ఇప్పుడు ఇది ఇన్బిల్ట్ ఎంత 64 ఇది 64 కదా నా జస్ట్ నా 6 కదా 6 కదా 6 ఇది 664 660 ఇది ఎక్స్ట్రా ఫోన్ చేసి ఎంత ఆర్డర్ చేసిన ఇంకోటి ఆర్డర్ చేసుకున్నా రాత్రి ట్రైన్ అయిపోయింది என்ன டிஸ்கஸ் நாட் ஐடி நல்லா சும்மா ஐடி காசு வந்து கூகுள் பே நோட்டிஃபிகேஷன் இன்னும் சேருது சரியா டபுள் ஐ First one, அது வடக்கடை ஜெயிபிஷன் தெரியும் ஒரு வார்டன் சும்மா సరే మహమ్మద్ ఒక్క ఈ దానికి ట్రై చేయాలి ట్రై అది మళ్ళా చేసి మా మెసేజ్ నన్ను తీసుకోండి నాకు సెట్ అయిపోయింది మళ్ళీ చేంజ్ చేయాలి వాట్సాప్ లో వస్తే స్కూల్లో హోంవర్క్ డైలీ అనిపిస్తాను వాట్సాప్ అవన్నీ వాట్సాప్ మీరు చూడాలి సార్ వాట్సాప్ లో చూసి తెలిసి మాకు పెట్టి అనిపించాలని చెప్పి ఆ ముందు పెట్టుకుంటే డబ్బా ఫోన్ మళ్ళీ సంవత్సరాలు నోకియా ఫోన్ ఊరికి పోయి ఫోన్ లేదు అప్పుడు నేర్చుకుంటే అది యాక్చువల్లీ ఫోన్ లేదు ఆ మొబైల్ ఛార్జింగ్ పెట్టదు మ్యాక్సిమం 5 రోజులు ఎంతకాలం అనబడద్దు
Okay, students, I'm back. Sorry for the break here. So needed to talk to somebody. Okay, there we go. So last class, we looked at two option strategies with the underlying asset and a derivative. So a call hedge and a put hedge. All right. Guys, am I audible? Students?
Yes, sir.
Yes, sir.
Thank you. Thank you. Okay, so basically we looked at this. So hedging with a protective put. So let's say you have a stock and no, my goodness, what's going on here? Okay, students. An example we looked at, and I demonstrated a similar strategy with the Nifty. We used the futures contract. And basically what we did is, let's say you own a stock and you think it's going to decline short term. What can you do? You can buy a put and protect yourself. And what kind of protection do you get? Very simple. For different scenarios, we looked at how the loss in the value of the stock is going to be offset by the gain in the value of the put. Okay, so what will happen is, no matter what happens, because you have a put, you will have only a minimum loss of 60, no matter which price the stock goes to. Yes, so closer to the value of the stock, if you have a strike price, you are hedged. So without a put, you will lose 440 if the stock goes to 0. Okay, so your loss is minimized in a put strategy. So now I'm going to show you again using Opstra Edge. Okay, so I'll go to options. Strategy builder. Okay, so what we will do is long put. In here we cannot use cash Nifty, so we will say I'm going to execute this buy Nifty futures and hedge with the long call. Sorry, buy futures means you are long Nifty. I'm going to hedge with the put option. So Nifty yesterday closed at 16,050. So we will hedge with the put option. So first we will add this. Now go look, have a look. So when you buy a futures contract, your probability of profit is 48.4, almost half. It can either go up or down. So your probability of profit, and the graph looks like this. If it goes down, you lose money. If it goes up, and your margin is 97,000. To trade one Nifty contract futures, you need to have 97,000 rupees in your account. Okay. Now I'm going to add a protective put. Okay. Buy, I'll do option. $28 put. I want to. Now, what should I buy, students, in this strategy? It's a protective put, so I'm going to use option strategy. I'm going to use a near the money. So we will save 16,000 put. We will buy. So I will do buy a put. So I have Nifty futures long position. I'm hedging that with a put. Are you clear?
Yes, sir.
Add position. Now you can see your probability of profit is reduced. But remember, your margin is also reduced. Yes. So you can see here, the advantage of this is that your maximum loss is only minus 11,707. Remember, one Nifty lot is 50 units, right? So that's not bad. So if Nifty goes down, right, your put will limit your loss. But however, if Nifty goes up, you're going to get those profit potential is unlimited. So max profit, if you see, is undefined here. Can you see that? That means unlimited basically. But your max loss is limited. What happens if you did not have the put? Your max loss will also be unlimited. If it keeps going down, you will be losing. Is that clear? Students?
Yes, sir.
Yeah? Clear? Everyone clear?
Yes, sir.
Okay, fantastic. Now we'll reset this and look at the next strategy. So what is in the next strategy?
Excuse me, sir.
Yeah.
A small clarification. So,
Yeah.
when we're doing our assignment for option trading strategies, so we'll be taking real life scenarios and we'll be basically implementing those strategies, or we'll be just taking on an example basis and.
Yeah. So, but what I will do is, okay. So, can we do that right now? We'll do it. So I'll just type in the chart, in the chat. Please send this in your chat room, in your WhatsApp. We'll assign one company to each student. How about that?
Okay, sir. Yeah.
So I'll assign you Infosys. I'll assign Mahesh from different sector. We'll assign. Mahesh, you have any company in mind? Or shall I assign something random to you?
Tata Alexi, sir.
Tata?
Alexi.
Okay. Options are there on this. Options and futures should.
I don't know, sir. I will see 1 minute.
Okay. Okay, you see that?
No, sir. Not available.
Okay. Mahesh, you take HDFC.
Yes.
Okay, Mahesh?
Yes.
What are the names of the other students? There was Kirti.
Yeah. Just a second, sir. I'll just let you know the other names as
No problem.
In addition to Kirti, we also
Goodleen
have
is there.
Gurleen is there and Manav is also there. I think he recently joined.
Yeah. Goodleen, what company should I give? Big blue chip company, Maruti, Suzuki. Okay. And what is that new joinee's name again?
Manav.
Okay. L&T. Okay, so can you copy paste this into the WhatsApp group?
Yeah, sure, sir. I'll do that right away.
So you can just you also type that you have to come up with profitable strategies with a high probability of success. So you know that probability of success is there. You should come up with option strategies on these companies and make sure you come up with a high probability of success. And you should come up with at least 5 different option strategies. Okay.
Strategies with the probability of success, right?
With high probability of success as per, I have typed that, you can just copy paste, as per Opstra Edge.
Okay, sir.
So basically what you need to do is look at the graph first and underline and analyze the trend first of all. That is the most important thing. Based on the trend, you have to come up with based on underlying trend of the stock assigned. Is that fine?
Okay, sir. Yeah.
You can send them the link to that Opstra Edge platform too. So these 2 assignments are what is going to get your internal marks. I think I should put a deadline for these assignments. We will make the first assignment, trading strategies. Deadline would be July 31st. Sorry, July 31st, is it? Yes. July 31st for trading strategies, which has already been assigned. And August 31st for option strategies. Is that fine? Yes.
Sir, for the first assignment, can we get a few more days?
We will keep that as of now, July 31st, but you can, yes, get a few more days. So shall I just make that then August 5th? So 15th is holidays, August 16th.
Okay, sir. Yeah, that would be good. Thank you.
So you can change it. So August 16th, the first assignment. And then I think the program will end by August end, maybe, I think. That's why I don't want to move the second assignment.
It will be for a duration of 3 months, right? So because for the first term also we started by end of February and we had our examinations by end of May, right? So maybe 2.5 months, if we take that into consideration, I believe we have time till maybe end of August. Not sure though. Sir.
End
Just
of
give me a
August,
second.
right?
Yes, sir. Just give me a second, sir. We got a
As per
tentative.
the schedule, we have exams at August last.
Okay, so we have to finish before that. That's the point.
Okay.
So that's why I made it like this. So August 15th and August 31st. Shall we keep it as of now?
Yeah. Okay, sir.
Okay. So don't waste your time just writing or anything. You can write about the strategies, a few lines, but take the strategies from Opstra Edge. Yes. Do not do anything manual. It will save you time. For option strategies, and use trading view or whatever it is to show the aggregate of trades. So you just explain your strategies. That's all I want. But all the data, use the sites to get all the data. Yes. Is that clear? Yes, no?
Yes, sir. Yeah.
Okay. Now, the next strategy we looked at is protective call. Now, let's say you have a short position. You have a short position in a stock or in a futures contract. In India, we all know we can't go short in the cash market. We can only do it in the futures market. And you think the market may go up in the short run. So then you need a protective put. So what is the function of a protective put? A protective put will protect you against short-term losses on a short position if the market were to go up. So So in a protective call, if you have a protective call, if the market goes up, yes, you are protected. Your call option will gain in value as opposed to your short position, which will lose in value and it will offset the loss. So with the protective call, if the market goes up, your loss is minimized. Okay, you could have unlimited loss potentially. Yes, if the price keeps on going up, right? So in this case, yes, your loss is minimized if the stock keeps going up. So that is the goal of a protective call. Is that clear? So let's try that on option strategies. So I will say, I want a protective call here. So options, I will say 16,000 call. Okay, this I will buy. Maybe we can go slightly out of the money, maybe protective call or slightly, yeah, exactly at the money, 16.5. So we will add position. Remember, our overall position is what? Yes.
Shorting.
Yeah. So this position, I think the premium is nearly 200 points is the premium. Okay, students. So what are we going to do? So this is the protective call position. But before that, we have to add our futures. Please remember. Futures, we are long or short?
Short.
Yeah, we are short. So we have to sell that. So you'll get a graph like this. So as long as price keeps coming down, your profits are there. But the moment that price keeps going up, your loss is minimized because you have the call option as a protective strategy. Yes? Is that fine? Yeah?
Yes, sir.
Any questions? Nidhi, questions? Yes, no?
No, sir. No, sir.
Okay.
No.
So you understand how it works, right? So basically you have a short position. You are betting things would go down, but you think in the short term market may go up. So you take a call to protect yourself. And the protective call will minimize your loss in the event market goes. Yeah?
Yeah, got it, sir.
Okay, fantastic. Okay, now today topics, we will touch on some important things. We are going to look at some spreads. In fact, spreads are the best way to trade options because those can give you, they will minimize your loss to an extent, but they will definitely expose. So spreads are today, most of the institutional investors always do spreads. Okay. So in a spread, we don't have any underlying asset involved. We only have option positions. Okay. You can have a bull spread for a bullish view. You can have a bear spread on a bearish view. So bull spread. What are we going to do for a bull spread? It is if you think the market is going up. So what are we going to do? We are going to buy a call on a stock with a lower strike price and sell a call on the stock at the higher strike price. The spread is the difference in the premium pays. If the stock is below the lower strike price at expiry, both calls will expire worthless and the cost of the spread is the loss. Okay. So basically the difference cost of the spread was the only loss you will incur. However, if the stock price appreciates, so the difference between the strike prices will be your profit. Okay, so here's an example of a bull call spread. So a trader is purchasing a 610 call for 42 and sell a 690 call for 26. So for different prices, what is the payoff at each spread? So the cost of the strategy is the difference in the premium paid. He pays 42 and buys a 610 call. So 42 goes out of his pocket. He's collecting 26 because he's selling a 690 call. 42 minus 26 is 16. So you understand? So he has to pay 16 for the strategy. So what is the gain? So assuming different prices, yes, if the stock price is 400 for 450, so both options are worth 0. Remember, so we are looking at the expiry date, so we are only concerned about intrinsic value. Yes, remember, cost of the strategy should be subtracted. Okay. On long call, you will always have a positive sign. Yes, because you have bought it. Short call, if it goes up, you will lose. So how do you calculate intrinsic value of a call option? Just refreshing so you understand this easily.
It is the difference between stock price and the strike price.
Correct. Absolutely correct. So in the first case, if you do that, market price minus strike price. Okay. The first case, it will be 0, no intrinsic value. It is out of the money option, right? We are assuming we have reached expiry date here. Yeah. 560 also same thing. 560 minus 610 would be a negative number. So we don't have any negative values, 0. 620 minus 610, we have an intrinsic value of 10. Yes. So price is, this is a bull call spread. So when price goes up, we make money. So 620 minus 610 is 10. You are long that, and short call is 0. So you make a net profit of 10, but you have already paid 16 as the cost. So you have to subtract 16 from all the entries. That's the cost of the strategy, difference in premium paid. So 10 minus 16, 6. Now what happens when the price keeps going up? So at some point you will reach a maximum value, which is basically the difference in the strike prices minus the premium paid by you. So your maximum profit here in this case is what? 690 minus 610 minus 16. So you will already know. So here you will have your loss will be limited to a certain extent. Your loss will be limited to the cost of the strategy, which is minus 16. But your gain is also going to be limited to the difference in the strike price. So minus the cost of the strategy. So maximum loss here is minus 16, whereas the maximum possible gain is 64. Are you understanding? So here gain is also limited, loss is also limited. But this is a good strategy, right? So you are paying 16 rupees to potentially make 4 times your money if everything goes well. If the stock goes up in value. Yes? Is that clear?
Yes, sir.
Yeah. So now let us execute this in Opstra Edge and see how this works. Strategy positions preset. So I will do spread. Call spread. Okay. Call spread is usually the bullish spread. So here what he's doing, you are buying 1600 call and selling 16350 call. So we'll say buy. So maximum profit is 7400 and the maximum loss is minus 5090. Yes. And what is our probability of success here? 38.49%. It's, as you can see, it is better than if you were to just buy a call option only and keep it, or a put option only, or in this case a call option only if you keep it, that is the probability of profit is less. But in a put spread, your probability of profit is much more. So your maximum loss is basically your cost of the strategy. So basically 5,900, 5,090 you make, and to make 7,410 is your maximum profit. So here your loss is also limited, your gain will also be limited. Of course, if you have a big difference between the strike prices, then your profit potential is higher. But usually you don't want too big a difference. Then your loss potential may also be good. So what about, let us say, we change this, modify this. And let's say I make 16,500 here. So now there's a big, your profit, maximum profit is very, very high, right? Yeah, but your probability of profit is also come down a bit. What if we increase this even further? And let's say make it 16,300 or yeah, 16,300, let's say. And I say modify. So in this, profit is high, but your loss is limited. But then look at this. The chances of success is only 28%. That reduces. Why is it reducing? Because both these options are out of the money. Now let's once again try some in the money here. So I'll say buy, and I say buy 15,900 call. Now look at that. But here the maximum loss is going to go up. But your probability of profit is higher. And if I were to modify this and make that near, let's say 16,000 here, modify. Now look at this. Now look at this. Your maximum loss is reduced. Your maximum profit is reduced. But guess what? Probability of success increase. So this type of strategy would make sense because you're sure that your profitability has, chances of your success is increased. So if you do the spreads within the money put options, your chance of success is increased. But remember, this is a bullish spread. So if prices go down, you will lose 3,180. And the margin you need is 16,000. Is that clear, students?
Yes.
Okay, fantastic then. Okay, next, what if you have a bearish view? So this is how the payoff diagram looks. Okay, what if you have a bearish view? So you are thinking prices are going to go down, so we do the reverse. So you buy a call on a stock with a higher strike price and sell a call on the same stock with a lower strike price. So spread gained is difference in premium paid. So if the stock is below the lowest strike price, both puts expire, worthless, and so your spread is the gain. Otherwise, there will be a small loss. So have a look at this. So bearish view, you have bear call spread. Bullish view, you have a bull call spread. Now your bull call spread will be the same as a bear put spread if you do it with put options. And a bear call spread will be the same as a bull put spread if you do it with put options. Both will give you the same results. Okay, students. So what can we do here? We can basically sell a call of high price and buy a call or the reverse of what we did the last time. What are we going to do? Buy a call of higher strike price and sell a call of lower strike price. So I will buy you can do something like this. Buy 350 call and sell 290 call. So in this case, you are collecting the premium. Yeah, that is your maximum profit. So in case the stock price actually goes up in value, yeah, if it goes up in value, then you will lose certain amount. So maximum possible loss near the 23 level, maximum gain is 27 if you do this strategy. So basically we calculate the intrinsic value of the options. If you are long call, you add it. If you are short call, you subtract the value, intrinsic value. And then you have to add the cost of the strategy this time. This time there's no cost of the strategy. You are receiving money. In the previous case, you paid money. So you have to subtract the cost of the strategy. In this case, you are receiving money. So you have to add your money received in the payoff diagram. Is that fine, students? So this strategy makes you money when? Bear call spread?
It limits our earning capacity.
It basically makes you money if the share price goes up in value, underlying asset goes up in value, down in value, it makes you some money, but it also limits your loss if it goes what? Sorry, this strategy is a bear call spread. So it will make you money if the underlying asset goes down in value, but if it goes up in value, your loss is limited to a certain. Is that correct? Yeah.
So the earning potential for this strategy would be less, right? Because it's like we are collecting money from premium.
Yeah, so you cannot get anything, you cannot make anything more than that.
Yeah. That's right.
So 27 is the maximum.
Correct. Yeah.
Yeah. And 23 probably will be a minimum. So what we will do, guys, is we'll go back to our Opstra Edge and execute this for Nifty and see. So what must I do here? Here, no futures. So we will do spread here. And we will use put spread. Put spread is for bearish view. You can also use call spread and do the reverse. But put spread and bull put spread and bear call spread are one of them. So we'll say this and we'll say buy. So as long as these put options are in the money, you will have a higher probability of success. 16,100 is not in the money. 15,800 is. So yeah. So this is how it looks like. So your maximum loss here, we are doing this with put options. You bought 16,100 put and you sold 8,500 put. Okay, why not we okay, now keep in mind this diagram and I will change this to call options. So I'll say call spread, but what I will do is I will make it to 16,200 buy, and this I will sell lower call spread. So this is what we talked about there. This will give you a similar looking graph. Bear call spread, bull, same looking graph, right? Yeah.
Yeah.
So maximum loss is almost 5,000, 5,000. But your probability of success is high because we have done bear portfolio. So when will this? If the price keeps going down, then chances of success are high. Yes? So as long as your price is declining, your chances of success are high. But what is your maximum loss? Minus 5,000. And if I modify this and bring it closer to 16,100, your probability of success will improve. No, it doesn't improve, but your gain loss improved. Your loss is minimized. You look at the RR ratio there, students, that is also very important. Please mention that in your strategies. That is risk reward 1 to 1.13. If our risk to reward is more than 1 to, let's say 2, 1:2, then that is a very good strategy. But this one is okay, 50% chance of success. Is that clear, students? Yes, no? Yeah?
Yes.
Any queries?
No, sir.
Okay. So if you have made a lot of profit, switch to spread-based strategies because you will not lose a lot of money. In option trading, you always lose. So spread strategies minimize loss. Okay, students. Okay, so what I'll do is I'll go back and play a video on spread strategies so your concepts are a little bit clear here. First, okay. I will play a video, interesting video.
Hi, this is Vijay Vambani and I'm recording this video from my residence. I'm still watching the market, keeping my finger on the pulse of the market, and I hope you're following suit. As long as you keep in touch with the market, you are basically aware of what's happening in the financial world around you. And in this video today, I want to bring to your attention a segment of the market that's fairly interesting, and as a trader, I'm talking about trading here, as a trader and in some cases even as an investor, you should sit up and take note of. I am talking about the options segment of the derivatives market. The derivatives market is also known as the futures and option or the F&O segment. F stands for futures, N stands for options. Now, contrary to popular belief, options are not as simple as they are made out to be. In a future, whether it is an index or an individual stock, it's just like buying the stock or the index with leverage. Leverage would mean borrowed money. In the case of an index, you pay approximately 10% of the value of the contract and 90% is funded by the market. And on that funding, you have to pay a cost of carry, which is a rollover cost. Obviously, in a normal market, the future will quote at a slight premium to cash, which is nothing but the interest cost. Options, on the other hand, are a little more different. They are unique in the sense that they allow a low cost entry to the options buyer, and to an options seller there are capital involvements such as span margins or security deposit, just as you would pay in futures, marginally lower of course, and that separates the option buyers from the sellers. How big is the options market? Now that is a very, very interesting thing to note out here. Today is the 7th of July 2020. I put up a lot of data at the end of the trading session every day on Equity Masters Telegram channel, which I would strongly suggest you join with the handle Equity Master Official. We put up a lot of informative, educative and profitable data out there, both for investors and for traders. And every day that I put up this data about the exchanges for traders, in the case of today, which is 7th of July 2020, I have put up data on Equity Masters Telegram channel listing the turnover on the National Stock Exchange in the derivatives segment as approximately 14,50,000 crores. A few crores here and there, of course. You will be surprised to know that the options segment itself has contributed over 13 lakh crores out of this entire 14,50,000 odd crores. Now, when I'm talking about options turnover, we are referring to the notional turnover, which means the capitalization or the value of the entire contract. Of course, what is traded is not the entire contract, but the premium thereof. But these figures I have taken from the NSE's website, so you may consider this as coming from the horse's mouth, the most authoritative source present out there. Out of these 13 lakh odd crores, majority, I would say more than 85% of the turnover came, hold your breath, from the index options, both the Nifty 50 and the Bank Nifty. So it does not require any rocket science to tell you that the lion's share of the turnover comes from the index options. They are the most liquid. You can get in and get out easily as a buyer. Remember, I'm talking about buying. To that extent, you basically could pay as little as 5 to 10,000 rupees to buy a Nifty or a Bank Nifty option, depending on the various strike price or the various targets that you have in your mind that you're betting on. For putting up as little as this amount, you can take part in the action. Now, before you get carried away, I want you to think that any segment of the market which allows such a low cost entry would be extremely competitive. It would be full of millions of traders throwing their hat in the ring, making educated bets. Some of them are basically throwing darts in the air, not knowing where they are throwing those darts. So all kinds of traders are coming into that melting pot of index options. The savvy traders would of course take money most of the times. There is no trader I know who takes money home every single trading session. That's like a white lie. The option sellers, on the other hand, don't get in and get out that fast like option buyers do. For the simple reason, like I told you, as an option seller, you need to put up span margin or security deposits. For example, if you wanted to sell a nifty call option, say approximately 700 to 800 rupees higher than the ruling spot market price, you would have to put up approximately 85,000 rupees as deposit to sell these options, which means that the option sellers sit on their positions rather than get in and get out of their positions. Consider an option seller as a motorist who's driving an SUV or a sports utility vehicle, a large Range Rover, if you want to call it that. Now, this guy is going to drive very carefully. He's not going to zigzag, kind of weave in and out of the traffic because he's scared of scratching his expensive car. The options buyer, on the other hand, is your normal average smoking Joe's or Domino's pizza delivery guy on a motorcycle. He zooms in and out of traffic, drives on the footpath. He's in a hurry to beat that 30-minute delivery deadline, failing which he will have to deliver the pizza free. So in this big melting pot called the options game lies the action. Here, let's take a look at the data provided by the exchange where it all started, the Chicago Board of Options Exchange, or the CBOE. Since these guys know options like nobody else does, it pays to basically pay attention to their data. What they have told us, and they have let it out in the public domain, is that 80 to 88% of the option buyers do not make money, for the simple reason that they don't know which option they should have bought or sold. Bought. Option sellers, on the other hand. Now remember, these markets, the financial markets, are a zero-sum game. Somebody's loss is somebody's gain. So what these 80 to 88% people are losing, the 12 to 20% people are taking home. Which is to say that in a race of a motorcycle against an SUV on an open highway, it is the SUV that wins. Here again, you should know which strike price of the options to sell. It's not just about throwing your money and saying, okay, I gave the nifty call option 80,000 rupees. Let me collect my profit at the end of the derivative cycle on expiry day and I'm going to go home assured of gains. Nothing can be further from the truth. You need some kind of hand-holding, some kind of knowledge-based inputs, calculated inputs as to which option you should be writing. That is where a scheme like my fast income alerts comes in. Just as James Bond says in many of his movies, especially I've heard Daniel Craig say this pretty often in James Bond movie, any fool can pull a trigger. It's a smart operative who should also know when not to shoot. To that extent, there could be times and prolonged periods of times when you should know when to hold back and not participate. There are times in this market when not doing something is also a part of the plan. And there are 12 months in a year. As an option writer or even an options buyer for that matter, do know that it is impossible to make money in all 12 months in a year. At the end of the day, every trader does meet his nemesis and has a losing month. But the trick is to have profits which are higher than the losses. As long as you're taking money home, that's going to be fine. Then you work on taking more and more money home. But the fact is that you should not be losing money at the end of the year. Secondly, in the options business, you do not calculate your returns on a trade by trade basis. You have to give it time and you take your returns, compute your returns at the end of the financial year. Because there could be some months in which the returns might be fairly mediocre, and in some months you could be beating the bank interest rate by a huge margin. The options buyer is actually looking at quick and abnormal returns. That is his aspiration. Whether he meets his aspirations or not, that is besides the point. The options seller, on the other hand, is a returns conscious, return sensitive investor or a money lender or an erstwhile Badla financer. This is something that I have written for Equity Master ages ago, that the erstwhile Badla financer of the Bombay Stock Exchange is not dead. He has returned in the market in a new avatar, in a new reincarnation as an options writer. Now, these are guys who are pretty happy with taking home 1.5 to 2.5, 3% interest on their investment per month. Of course, the figures are hypothetical. So here, options writing is not a multi-bagger kind of activity. Here, you're basically trying to beat the cost of living, beat inflation, beat the cost of capital combined with the fixed deposit interest rates. As long as you know your game, as long as you know that you are a kind of a trader whose attitude is suited to which kind of trading. Are you the kind of a guy who would like to have a motorcycle like a pizza delivery boy weaving in and out of traffic? You're looking for action. You don't mind losing money once in a while, but you want a fast, quick trade. Then you should be an options buyer. Or are you the kind of a guy who likes to drive in the cool comfort of an air-conditioned SUV, but you know there are times you're going to be bogged down in traffic jams, you're not going to be weaving in and out of the traffic, you don't have the luxury of allowing somebody to come and scratch your vehicle and bear expensive repair bills? This is a question that you need to answer. And of course, what suits your pocket? Once you figured this out, and once you basically subscribe to Equity Master's Telegram channel, you will see a lot of inputs coming in there every evening. And in case you still need some hand holding and some specialist advice, you could always get in touch with the customer service and ask for details of the fast income alerts. Also, join me for my fast income alerts
just
summit
thing
on
about
Equity
options.
On this note,
Options.
I bid goodbye in
Look at
this
the
video till we
spread
meet
thing.
again in my next. If you're watching this video on YouTube, don't forget to click like on this video and subscribe to my YouTube channel. In the comment section, do let me know what you think about this video and what you would want me to record in my next video for you.
Hello and welcome to Learn Option Strategies with Sensible. So today's strategy is bear put spread. So friends, bear put spread is a bearish strategy, but it is quite different from buying a put option. So if I can explain it to you in few words, the bear put spread is a cheaper put option and the time value decay is very less than naked put buy. So your market view in this strategy is moderately bearish. That is, you're expecting a big but limited downside move. So now let's see how you can perform this strategy. First, you'll buy a put option at any strike, and then you will sell a lower strike, a cheaper put option to reduce the premium. Usually the bought option is ATM and the sold put option is OTM, but you can do ITMs also in this. So when you do this strategy, you will have to pay the premium, and there is a requirement of margin in it. But the margin is much less compared to the naked option sell, since your positions are hedged in this strategy. So when do you do it? So you perform this strategy when you are expecting a big but a limited down move. So maximum loss you are going to have in this strategy is net premium, and the maximum profit you are going to have in this strategy is the difference in the strikes minus net premium. We'll see this in detail when we will discuss the payoff diagram. So let's discuss the pros and cons of this strategy. First, pros: it is cheaper than buying a put option because you're selling an option, so you will receive some premium, and you pay only for the limited down move you are actually anticipating. And third, there is a less theta and low IV risk in this strategy. So talking about cons, there are not so much cons in this strategy. Now let's discuss the effect of time and volatility on this strategy. So as time passes by, you will lose, but there will be very less time value decay as compared to naked option buy, and as IV goes up, you will gain, but again that will be very less also. Now let's see the payoff diagram of bear put spread strategy. So when you buy a put option at a strike, let's say S1, you pay the premium for that, and after that you sell a put option at a lower strikes, a cheaper put option, and you receive premium for that. Now the maximum loss you're going to have in this strategy is when your stock expires above the strike S1, that is in this region, and the maximum loss you're going to have in this strategy is the net premium, that is premium paid minus premium received. Now the maximum profit you're going to have in this strategy is when your stock expires below the strike S2, that means in this region, and the maximum profit you're going to have is strike difference S1 minus S2 minus net premium. So if your strikes are 15,000 and 14,500, the strike difference is 500, and you minus the net premium from that, that is your maximum profit in this strategy. And if your stock expires above the break even, you will make some losses, and if your stock expires below the break even, you will make some profit. Now we will see how you can create this strategy in Sensible Strategy Builder. So you will click on Strategy Builder. After that, in Ready-Made Strategy section under Bearish Strategies, you will find the Bear Put Spread. So when you click on Bear Put Spread strategy, the strategy will get loaded here, and from here you can change your strikes, and from here you can change your expiry. So this is the payoff diagram we just saw. So here the brown line indicates your profit or loss on the expiry, and the blue line indicates the profit or loss on the target date. So you can choose the target date and time from here, and you can select the target price from here, and now you can analyze how much profit you are going to have for a particular price on a particular date and time. So you can analyze that projected P&L here. The other data that Sensible Strategy Builder will give you is max profit, max loss, break even, probability of profit, the margin needed or the fund needed for that particular strategy. So here is the summary chart for strategy bear put spread. So if you want to learn more about options strategy, So you can go to this learn option trading and education by Sensible. Here you will find the structured
Okay,
code.
students. So that explains one of the put strategies I talked about. So he has explained it well. So hence I put this video. Any questions, students?
No, sir. Nothing on my end.
Okay, so for bull put spread for bullish strategies, bear put spread for bearish strategies. Now, there is one more put strategy which goes for a combination of more options. So not a put strategy, but an option strategy. It's called the butterfly spread. Now, what happens if you think that the market is just going to be quiet and stay between two levels, not going to do anything? Let's say you think that the market will remain between 15,800 and 16,200. So is there a strategy for that? Market, let's say the market doesn't move anywhere, it just stays between the, stays calm. So for that, there is something called a butterfly spread. We will look at that next. So this is what we discussed, bull spread using puts. Okay. So butterfly spread is basically, if you think situation is going to be, the market is going to be calm and doesn't move outside the range of two strikes. So what will, here we will, this strategy is a combination of 4 options. Okay. Now there's one more strategy also we will discuss, which is called the iron condor strategy. I'll just play a video on that. It is an extension of this, but if we think the price is going to stay within a defined range, then these strategies are used. So in a butterfly spread, what will we do? We will buy a call option with a lower strike price, buy a call option with a higher strike price, then sell 2 call options between the high and low strike price. So essentially, what is this? It is just a combination of bull call spread and bear call spread, right? Am I right? Yes, students?
Yes.
So if I combine bull call with bear call strategy, you'll get a butterfly spread. But butterfly spread is for non-volatile market. The market says closely between 2 defined strike prices, then that will work. Okay. So how can we do a butterfly spread? So stock is selling for 72. Following data applies. So create a butterfly spread and determine the payoff. So what will we do here? Butterfly spread. So we will buy 65 call, buy 75 call, and sell 2 70 call options. Okay, students? So remember, for this strategy to get us maximum profit, what do we require? The stock should stay between the highest and lowest, 65 and 75. Right in the middle is where maximum profit. Anywhere else, you will have a limited loss of 1. So here it is very limited loss and very limited profit as well. But we are doing this as long as stock stays within a highest and the lowest time. Is that clear, students?
Yes.
Okay. So we will have a small loss if the stock moves outside the strike prices, but we will have profits in between 65 and 75. And when it is right in the middle, exactly, let's say at 70, you will get the maximum possible profit. Average of the highest and lowest strike price, right in the middle is when you will have maximum profit. So can we execute this in option strategy, upstrade?
Yes.
So remember call spread. Remember the strike of the call we sold. So we'll have to sell one more option. Okay. And then we have to buy something at higher strike price. Okay. So let us assume 6,100 and 6,500 as our strike prices. Okay. So we are buying 116,100 call. Okay. We are also going to buy another 16,100 call, 16,500 call, and then we are going to sell to 16,300 call. 16,300 will make buy. Spread. This way will go 16,500. Sell 16,300. Buy. Let's look at this. So does this look like a butterfly to you? Yeah, with
Yes,
the
sir.
wings flapping. So what is the maximum profit?
8,000.
8,000, maximum loss 1. But look at the probability of profit, only 22%. Why is that? But look at the risk reward ratio though, 1 to 4.75. So the reason the probability of profit is low, can anybody tell me?
It depends on current market trend.
Correct. The market will fluctuate too much, right? So very easily it can go below 16,100 or 16,500. Correct. Correct. No.
Yes.
So if you broaden the range, okay. So let us say 16,000 to 16,500. Now 6,000. So why don't I broaden the range? So let's say I make this, edit, and I make this 15,800. Right now we have done with out of the money. We'll add one in the money strike. So 15,800 we will add. As I modify. Now look at this. What about this? So we can be for certain, for sure, that the price may stay between this range, right? 15,800 to 16,500. Yes? Yeah? Look at the probability of success. So here, look at the risk reward ratio. 1:13. Okay.
Yeah, yes, sir.
So that's a very good risk reward ratio for a non-volatile market. And if the market goes below, out of those range, yes, then you will still lose only 1740, right? Looks like a very good strategy, right? Yeah?
Yes, sir.
But Nifty is crazy, so sometimes it can go outside that. Yeah? And if I change this and increase the range to 16,700, look at that, the probability of success even goes up. So the more you increase the range, yeah, the better it is for you. Now, what if we reduce the expiry date? Next week expiry, let us do, just for grins. What is next week's expiry? 21st July. Modify. Again, the probability of success goes up, right? Again, for everything we will do like that. So the shorter the expiry, again, your probability of success is going to go up. I don't know why that doesn't take much. 21st July. Because very good probability, high odds that the market will stay within this range in the next week. In 2 weeks, it may change, but in 1 week, it may. So anyway, you can play around with this and change it. But you can see the probability of success is very high because we are saying the market is not going to move too much. Okay, students, is that clear? Yes?
Yes, sir.
Okay. So now we will look at this a video which explains this. Let's see.
15 साल हुए मेरे हस्बैंड को उनकी डेथ हुई उसके 2-3 साल बाद मेरा जवान
As an investor, you're always looking for opportunities to make a profit. So if you look at an opportunity and you see that a stock is likely to go up in price, there's several things you can do. You can buy the stock, you can buy a call option, or if you think the stock price is going to go up but not a whole lot, you can create a bull spread. And in a bull spread, what you do is you buy a call option and then you sell another call option that has a higher exercise price, and that offsets some of your cost. And I've created a tutorial on bull spread, so if you haven't seen that, you may want to take a look. If you think the price of the stock is going to go down, then you can short sell the stock, you can buy a put option, or you could create a bear spread. And in a bear spread, what you're going to do is you're going to buy a put option, and then you're going to sell another put option that has a lower exercise price. And again, I have another tutorial on that, which you might want to look at. Now, suppose you think the price of the stock is not going to move much at all. Is there a way to create a strategy that will allow us to profit from that? And the answer is yes. We can use what's referred to as a butterfly spread. And a butterfly spread is really just a combination of a bull spread and a bear spread. So suppose we have a stock that's selling for about $80 a share, and we don't think the stock price is going to change much. We think it's going to hover around 80 bucks a share. How can we create a strategy so that we get a profit as long as it hovers around $80 a share? And you can see here I've listed 3 different call options because we're going to need 3 options to create this butterfly spread. You can also do it with put options, but I'm going to do it with call options here. I have a 75 call. That is a call option with an exercise price of 75 that sells for $10 or has a premium of $10. I have a second call option that has an exercise price of 80 and it costs $7. And then the third option has an exercise price of 85 and has a premium or price of $5. So in order to create this butterfly spread, what we're going to do is we're going to be long the 75 call. That is, we're going to buy one of these. We're going to be short not one but 2 80 calls. That is, we're going to sell 2 of these, and then we're going to be long or buy the 85 call. And so the first thing we want to figure out is, what's the cost? Well, the cost is going to look like this. We're going to pay $10 for the 75 call, but we're going to sell 2 80 calls at $7 each, so we're actually going to make money, or our cost is going to be minus 14. Okay, we're going to actually, remember this is a cost, so minus 14 means you're getting $14 in revenue. And then we're going to buy the 85 call, and that's going to cost us 5. So if we add all this up, this is going to cost us $1. So let's go over to our diagram here, and we're going to see that we're going to start $1 in the hole. Okay, it's going to cost you $1 to create this strategy. Now let's see what our payoff looks like. If the price of the stock is below 75, there's no reason to use the option or the right to buy at a price of 75 when the price of the stock is, let's say, $60 a share. Right? You just go to your brokerage account and you'd buy it for $60 a share. So there's no reason to buy for 75. The person who bought the 80 calls from you, they're not going to use their option either. Again, why would they buy the stock for $80 a share if it's selling for 60? And the 85 call you own, you're not going to use, again, for the same reasons. So what you're going to get is you're going to get a horizontal line until you reach 75. Let's see if I can make that a straight line. Once you reach 75, what happens? Well, for every $1 it goes above 75, you're going to make $1. And as long as the price is below 80, these options, these 280 calls that you sold, are not going to be used, again, for the same reasons we discussed before, and the 85 call isn't going to be used. So what's going to happen is this is going to turn up at a slope of 1, and it's going to go up until we hit 80. What happens once we hit 80? Once we hit 80, you'll still be making $1 for every option you sold here, or I'm sorry, for this option that you bought here, but you'll be losing $1 here. Now remember, from a bull spread, we had sold 1 call option, so it would flatten out. But you've sold 2 of these, so the first one would flatten it out. The second one would cause you to lose $1, right? You're going to lose $2 for every dollar it goes above 80. You're still going to be making $1 here. So this is going to turn down. And it's going to turn down with a slope of -1. And it's going to do that until we hit 85. Once we hit 85, for every dollar that it goes above 85, you're making $1 on the 75 call you bought. You're losing $1 on the 80 calls that you sold. Remember, you sold 2 of them. And then you'll be making $1 from the 85 call, so it's just going to flatten out. Okay? So your profit's going to be 0. And it's going to look like this. So let's think about this. Let's see what we have here. We have, let me change my pen color here. We're going to have a break-even point of 76 here, right? Remember, you paid $1, so the price of the stock has to go $1 above 75 in order to break even. And you're going to have another break-even. You have 2 break-even points here. Your break-even point over here is going to be 84. Your maximum profit, if the stock price stays right at 80, is going to be $4. So it's kind of a neat strategy. We've created a strategy that makes us money as long as the price of the stock doesn't change much. Okay? As long as it stays above 76 or below 84, we're going to make a profit. If it gets above 85, we're going to lose $1. If it goes below 75, we're going to lose $1. So it's a quite inexpensive strategy for profiting if the price of the stock stays right around where it is. And again, a good strategy to use if you don't think the stock price is going to change much. Remember, when you use option strategies, usually you're doing them for 3 months or 6 months, short time periods, sometimes shorter than that. The price of the stock probably isn't going to change very much. So it's an inexpensive way to pick up a small profit. So this is a way to profit from the stock price not changing very much. We can actually create some different strategies that would change the picture even a little bit from this. And I'll discuss those in future tutorials.
So students, you understood what a butterfly spread is clearly, right?
Yeah, yes, sir.
These videos sometimes make it a little bit more concrete. So that's why I play them every now and then. So now an extension of this, we'll look at something called an iron condor strategy. And we will execute it in the upstrike.
What you are looking at is an option chain of Netflix, and these options have 37 days until they expire. Here are the out of the money calls and puts, and we know that if these options remain out of the money, they will gradually go to 0. And I'll just show you an example here. Let's just reference the 90 strike put. It's trading at 335 by 350. Now let's fast forward to the options that expire in just 2 days. You can see that they are all much cheaper. And if you look at the 90 strike put that expires in 2 days, it's only at 11 cents by 15 cents, whereas the 90 strike put with 37 days to expiration is at 335 by 350. So each and every day, time premium is sucked out of these options. Now, if you buy options, you already know that you are constantly fighting this time decay. Instead of fighting it, we prefer to let it work for us and make us money. Let me show you one of our favorite option strategies that you can start utilizing immediately to put time decay in your favor even with a small account. We can achieve this by trading an iron condor. So what exactly is an iron condor? Don't let the name intimidate you, it's actually very simple. The first part of an iron condor consists of selling to open an out of the money put and simultaneously selling to open an out of the money call. We would do this in hopes that between now and expiration, the stock will stay in between the strikes and the options we sold will go to zero. If this is the case, we will keep the entire price we sold these options for. But since short naked options can have a lot of risk and can require a lot of capital, we are also going to buy a further out of the money put and call for protection. These 4 option trades are collectively called an iron condor. But we're selling 2 options and buying 2 options. So how does this work? Well, let me show you. Stock XYZ is trading at $75 per share. Let's sell the 85 call for $2, and we're also going to sell the 65 put for $2. And our idea is that the stock will stay in between these strikes and the options we sold will expire worthless. But again, since naked options theoretically have unlimited risk, we are going to buy some protection. So we're also going to buy the 90 call for $1 and the 60 put for $1. And I know that keeping track with all of these individual option trades seems like a lot to keep up with, but we can actually trade an iron condor with one order and view it as one trade. And I'm going to show you how to do that in the end of the video, but for now just stick with me. Let's say we initiated this trade with 30 days to expiration. And as time passes and we near expiration, let's say the stock doesn't move much and just kind of bounces around and trades sideways. So as we near expiration, these options remain out of the money and the price of each option gradually goes to zero. If all of these options are worthless, what does that mean for our trade? Well, we make $200 on the 85 call and also on the 65 put because we are short those options and they are now at zero. So we collected a credit, and since they are of no value, we get to keep that credit. Okay, but we also lost some money on the options we bought as protection. We lost $100 on the 90 strike call and also on the 60 strike put because we bought these options and they now have no value. Adding all of these numbers up totals to a net profit of $200 because we made $400 on the short options and lost $200 on the long options. So by trading an iron condor, we are simply betting that the stock will stay within a certain range, and we treat it as one trade. We lost money on the long call and put, but that's exactly what we want to happen because we simply bought these options as protection. It's kind of like we pay for car insurance, but we don't actually want to crash our car. So now that you know how we make money on the trade, let me show you how we can lose money and also how much we can lose. Let's say the stock goes crazy, and although it was completely unexpected, it goes well outside of our range we wanted it to stay in and ends up at $96 per share. Well, we already know that both the long put and the short put are out of the money and are worthless. So we made $200 on the short put and lost $100 on the long put. So this totals to a net profit of $100 on the puts. But what about the calls? The 85 call is 11 points in the money, so it's worth 11. And the 90 call is 6 points in the money, so it's worth 6. We are short the 85 call at 2, and it's at 11, so this means we lost 9 points, or $900 on that leg of the trade. So that sucks, but fortunately we bought the 90 call for protection. We paid $1 for the 90 call, and it's now trading at 6. So we made $500 on that leg of the trade. This $500 and the $100 we made on the put side cancels out much of the $900 we lost on the short call. Adding up all of these numbers totals to a net loss of $300 on the entire trade. Now, this is the cool part. We lost $300 on the entire trade, but that's the maximum amount we can lose on this trade, no matter where the stock is. It doesn't matter if the stock goes to 104, 25, 0, infinity, whatever the case may be, we can't lose more than $300 on this trade. And the way we end up with this max loss is if the stock is outside of our long option strikes at the expiration date. Now, I keep mentioning how we treat this trade as one trade. When we trade an iron condor, we are usually just monitoring the price of the iron condor as a whole. Check out this iron condor we just opened in Facebook. You can see that when we trade an iron condor, the platform automatically calculates everything for us. We are able to see the individual legs of the trade, but we are also able to see the total net prices. In this example, you can see we sold this iron condor at $1.12. It's currently trading at 82 cents, and we have a profit of just $30 on the trade. When trading an iron condor, our maximum potential profit is simply the price we sold the iron condor for. In this example, we sold the iron condor for a net price of 2. So our maximum profit is $200. Our maximum loss is simply the width between our short and long strikes minus our net entry price. So in this case, our strikes are 5 points wide on both the call and put side. And if we subtract our entry price from that, we get a max loss of 3 points, or $300. This $300 is also our capital requirement for the trade. This is the reason the Iron Condor is so powerful, because we can sell option premium with very little risk and also without the large capital requirement. Now, our break-even prices that we need the stock to stay between is just our entry price plus the short call strike, and on the downside, it's our short put strike minus our entry price. And at the expiration date, if the stock stays within this range, then we make money, and if the stock is outside of this range, then we lose money. And I know this seems like a lot to keep up with, but check this out. Before entering the trade, the Thinkorswim platform will calculate all of this information for you. On this pop-up box, you can see your max.
Okay, students. So Iron Condor strategy is the next type of strategy. These are not spreads, but these are combinations because they involve combinations of calls and puts. Okay, students. So let us try and execute this. So I'll reset. Iron Condor. Remember, here we are going to sell an Iron Condor. Yeah. And when you're selling an Iron Condor, what do we want? We want the price to remain between 15,500 and 16,600, high and low. So we'll do add short Iron Condor. Similar graph to what he showed in the video. Yeah.
Yes.
So you in Iron Condor, when you sell Iron Condors, your probability of success is actually quite high. Yeah. %55 success. Max loss if by chance market goes beyond 15,750 or 16,600, which can happen every now and then. Your maximum loss is minus 782, and your margin is about 45,247, and the maximum is 4680. That's the maximum profit you can make in this strategy. So Iron Condor is also for what type of market, students?
Sideways.
What now? Sideways market. Yeah, non-volatile. Yes, students. So if the price will stay, you in this case, what is your bet? You are saying the price will not go below 15,500 on downside and won't exceed 16,600 on upside. Yeah. But the moment it starts going, then you experience your losses. So for next week, maybe you can do an Iron Condor because only few days are there. But you never know, right? Suddenly the market can crash or make big moves. But given where the market is now, 16,000, little chance it can go next week above 16,600 or below that lower strike price you have, 15,500. 500 each way is pretty good, right? What do you think? That's why the probability of success is high in this. Yes, students? Clear? But this one is not a spread strategy. It is a combination because it involves combination of puts and calls. Okay, students, any questions on any of the strategies we have discussed?
No, sir.
Okay, so we'll continue with this. Okay. Okay. So we'll go to the box spread. So box spreads basically combine calls and put options. Okay. The first one, most popular one, is straddle. Okay, students. So straddle involves buying a call and put option at the same strike price. Yes. So you will pay sum of the two premiums. And what is the strategy suitable for? Very volatile market. If the market is going to make a big move, but you don't know which way it is going to go. So you buy a call option at the money, say the 16,000 call and put you buy and keep, and you will make money past the premium paid. Sum of the premium paid would be the strike price minus the sum of the premium paid would be the break even. So on either side of the break even, you will make money. So have a look. So let us try to execute this. So you will buy a call and put option with the same strike price. And what type of market is this suitable for? Extremely volatile market. Extremely volatile. If the market is making a big move and you know it's making a big move, but you don't know which side it's going to go, this is perfectly suitable strategy. This is the reverse of the butterfly spread. Butterfly spread, you make money when there is no movement. Here you make money when there is extreme movement. So which is common? Extreme price movement or steady movement?
Steady movement.
Yeah, often it's steady movement. That's why the butterfly spread will always give you higher probability of success than this one. But every now and then, now the market is not making steady movement every time. It's making a big moves, right? So this can potentially be profitable. When the market moves steady, people often sell straddles, don't buy them. And selling straddle works a lot. Okay. We will also look at a case study later on. I'll show you a small video of how one person destroyed his entire bank, the Barings Bank, when he executed a sell straddle. You have to understand the market. You cannot sell a straddle when suddenly some recession news comes and the markets go crazy. So he did some kind of a strategy like that and he got wiped out and his entire bank went under business. So we will look at that also. So have a look. So can we create a straddle with this situation here? So how do we do it? So you have a long call and a long pull at 40. Your cost of the strategy is 5. So plus or minus 5. Below 35 and above 45, you will make a lot of money. Potential profit is unlimited. The loss will be limited to the sum of the premium you. Yes, students? Yes? Understanding?
Yes.
Okay. And the diagram looks like this. Yes. So if the price stays between the two strike prices, then you will lose your cost of the premium paid. If it makes a big move on either side, you have potential for unlimited profit. Okay, students. Now, let us go to Obstra Edge and execute this. Can we do that? Okay. Straddle. Probability of success will be low in this strategy. I say buy. So this is a sell straddle. Sell straddle actually chances of success are high in this. Why is the chance of success high in selling straddle? When you buy straddle, you need a big move down. In sell straddle, you want the price to be close to 16,000. So the break even, so as long as the market stays between 15,600 and 16,400, you are safe. Yes. Only when it goes on the other side, you have a problem. This is sell straddle. What about buy straddle? So buy straddle, again, potential gain is unlimited and potential loss is limited to the premium. Yes, students? Now, an extension of the straddle is what is called a strangle. A strangle, see here in a straddle, we are dealing with puts and calls of the same strike price, right? In strangle, we will do out of the money put and call. You'll either buy strangle, out of the money put, out of the money call, or you will sell strangle, out of the money put, out of the money call. So I will walk you through the video for the straddle. I'll throw this open for questions.
फ्यूचर और ऑप्शन में कभी पैसा नहीं बनता है। फ्यूचर का कोई फ्यूचर नहीं है और ऑप्शन आपको समझ में नहीं आएगा। क्या आपने ऐसा सब सुना है?
Hey everybody, Chris here from Project Option, and in today's options trading strategies video, we're going to talk about the long straddle. Now the long straddle strategy profits when the stock price makes a significant movement in either direction or when implied volatility increases. So in this video we're going to talk about the general characteristics of the long straddle, and then we're going to talk about the expiration risk profile graph, and then we're going to finish off with a couple real long straddle trade examples so that you can see how the position performs in various scenarios. So let's dive right in. Alright, so buying straddles, or sometimes referred to as a long straddle, is an option strategy constructed by buying a call and put option at the same strike price and in the same expiration cycle. Now most of the time the at the money strike price is used. Now the maximum profit potential of a long straddle is theoretically unlimited because you do own a call option and there's no limit to how high a stock price can rise. Now the maximum loss potential for a long straddle is the debit paid times 100. So if you pay $10 in premium for a long straddle, then your maximum loss potential is $10 times 100 or $1,000 per long straddle. Now the maximum loss is a very rare scenario because that only happens when the stock price is right at your long straddle strike price. So most of the time a long straddle will expire with some intrinsic value, but there still could be a substantial loss there if the stock price does not move away from that strike price. So the expiration break-even prices are going to be the strike price plus the debit paid and the strike price minus the debit paid. So to make money on a long straddle at expiration, the stock price has to have moved more than the debit you paid away from the straddle strike price. It doesn't matter if that movement is up or down. Now, since you need a large stock price movement to profit with a long straddle, the estimated probability of profit is less than 50%. Now, the resulting position after expiration depends on if the long call or the long put is in the money. So if the long call is in the money at expiration, then a long straddle will expire to plus 100 shares of stock per call option that you have. Now, if the long put is in the money at expiration, then the position will expire to negative 100 shares of stock per long put. So that's essentially a short stock position of 100 shares per put that you own. Now, since a long straddle does not include any short option components, there is no early assignment risk. All right, now let's apply those general characteristics to a hypothetical long straddle position. So at the time of these option prices, let's say the stock price is trading at $250, and we believe the stock price is going to make a significant move in either direction. So to construct a long straddle position, we're going to buy the 250 put for $15.10, and we're going to buy the 250 call for $15.20. Now that's going to bring our net debit to $30.30. So let's go ahead and take a look at the expiration risk profile graph for this position. Okay, so as we can see here, we bought the 250 straddle for $30.30, and as we can see based on this graph that our maximum loss potential is $3,030. Now that comes from the $30.30 debit we paid times 100. So if the stock price is right at 250 at expiration, both the long put and long call that we purchased will expire worthless, and we'll lose the entire debit that we paid. Now our break-even prices in this example are going to be the strike price of $250 plus the debit paid, and the strike price of $250 minus the debit paid. So our lower break-even price is $219.70, and our upper break-even price is $280.30. And lastly, we can see that there's significant profit potential when the stock price increases or decreases significantly. So when you buy a straddle, you're betting that the stock price is going to make an outsized move, and if it does not, then you will lose money from time decay as time passes, because those long options that you own will be losing their extrinsic value. Alright, so now that you've seen the expiration risk profile graph and the general characteristics of the long straddle strategy, let's go ahead and take a look at the Greek exposure so that you can understand how the position is expected to perform before it expires. So in general, the delta of a long straddle will begin at 0 because most of the time people will buy an at-the-money straddle. And that means the call delta and the put delta will be offsetting each other, and you'll have virtually no directional exposure. However, you can structure a long straddle in a directional manner by purchasing an out-of-the-money strike price. Now that's not very...
Okay, students, I will talk about options, the delta, gamma, theta, etc. later on. When we talk about option Greeks, we will look at that in more detail. But for now, this is how a straddle works. Okay, students. One more video on when to choose what strategy, particularly straddles and strangles.
Hey, what's up everyone? This is Kirk here again at Option Alpha, and tonight we are going to talk about the difference between using straddles versus strangles. We're going to do something a little bit different here because I like to draw and I like to use some of these like little whiteboards or papers that we're going to do. So in today's talk, obviously, the different two strategies that we're going to look at, we're going to do both kind of looking at the payoff diagram for each of these, and then also just kind of how you use each of these different strategies, because a lot of people have questions on how to use them, when's the best time, the whole deal. So we'll get into that here in a second. So what we want to do first is talk about straddles first, and straddles are probably one of the simpler option strategies to understand because it's basically just selling an at-the-money call and an at-the-money put. So your payoff diagram looks like this. If you're going to do a short straddle, you would sell the same short strike put and call. So it would be like, in this case, you would sell the 50 strike put and the 50 strike call. Now, the beautiful thing about doing a straddle is you collect a lot of premium because those options are worth a lot of money. So by doing the straddle and by selling those for a lot of money, that also moves out the break-even point, which is why you have this kind of pyramid shape here. So you might sell a straddle for, let's say, $350 when it's doing the at-the-money options. Now, a strangle, on the other hand, is selling an option that's out of the money on either end. So you'll be selling an out-of-the-money put and then selling an out-of-the-money call option, and you're going a little bit further out, and you generally have much wider break-even points, generally speaking. But because you're going further out, you collect less money. So this option, again, if the stock is trading at, let's say, $50, you might sell the 35 strike put and the 65 strike call or something like that, right? So you would go a little bit further out on either end. And in exchange for going further out and potentially having a higher probability of success, you might then collect less money. So let's say that this strangle here collects, I don't know, let's say just $1 to use round numbers, right? So it could be different for different stocks, but the whole idea here is that when you do a straddle, you're going to go at the money, really aggressive, try to maximize the premium that you've collected. And when you do a strangle, you're going to go a little bit further out and you're going to collect less money, but you're going to have potentially a little bit higher chance of success, okay? So those are the two main strategies there, and I can barely see the screen on my end because I'm writing on this thing. So if you guys have questions as you're joining in here, please let me know in the comment section, or definitely if you want to see other strategies or techniques. Now, the way that we generally use these option strategies, just so you can see how it kind of looks with the stock chart, but let's say that, we have a stock that's just moving, right? And all we would want to do with a stock is to bracket it in some sort of profitable range, right? So that's what's different about options trading, at least the way that we do it, is that I don't care necessarily if the stock continues to go higher or from this point it goes lower or sideways. Like, it doesn't matter at this point with the strategy. Your break-even points are out here much further than where the stock is trading at the moment. And so all we're trying to do here at this point is just take advantage of the fact that the stock could potentially trade inside of a 70 or 80% probability zone, right? So that's what we do. We'd sell a call option up here if we're doing a strangle, right? Or sell a put option down here. And by doing this, again, you give yourself a 70%, 80%, whatever you want to build. You build out whatever probability of success level you want to get to by selling these options, right? So that's the whole idea with doing this type of strategies. You're basically forcing the market to make an extended move in one direction or another that it won't generally make over time, right? And if it doesn't, then we keep that premium 70% of the time or more, right? We've actually found in most of our back testing that we keep that premium much more than 70% of the time. So when would you want to use a strangle or a straddle? I guess that's the question that most people have all the time is, what are the best times to use these types of strategies? Well, here's what we basically say, right? We basically say that when there is lower volatility, or IVR as we define it, when there's lower IVR, you generally want to go with the strangle. And the reason you want to do that is because you just don't want to be super, super aggressive selling premium. You can go with the strangle. You can go a little bit further out. You want to maximize your probability of success. And in exchange, you're going to give up a little bit of the premium that you could collect, but that's okay. When there's higher IVR or higher implied volatility rank in the market, higher implied volatility across the board, then what you want to do is you want to go ahead and choose the straddle. So you want to go a little bit more aggressive with your type of trading strategy so that if the market does see that quick drop in implied volatility, then your potential premium is going to realize itself much quicker. Now, people have an issue with the straddle because you're selling at the money options. They think, oh, that's too risky, or you're selling an option and it's one's in the money at all the time and could be assigned. But again, go back to some of the other videos that we've done. Assignment doesn't really happen most of the time until the week of expiration. So yes, you can technically be assigned at any time, but you're collecting a lot of money up front and you're going to try to maximize that time basically, or that potential profit much sooner. So you're going to capture that profit sooner, get out of the trade sooner, manage it sooner, whatever you want to call it, a little bit faster. So you collect more, but you also get more upfront, right? Now, what other people always have questions on, and this is one more thing before we end up here tonight, is how do I convert these strategies if I'm not in an account that can trade an undefined risk position, right? So many of you might even have that question, like, what do I do if I'm trading, if I want to trade a straddle or I want to trade a strangle, but I'm in an account that has an undefined, or that doesn't allow margin, doesn't allow me to do that. So here's what we're going to do, and I'm going to try to draw this on this top half here because I'm running out of paper. My daughter keeps stealing paper from me. But here's what you would want to do. If you are trading the strangle, if that's the basis of your position, and if you're trading in an IRA or risk-defined account, all you want to do is you want to go really far out on either end, and you want to buy these wings and create what's called an iron butterfly. So again, all you want to do is you want to go really far out, and you want to buy cheap options out of the money. So you buy a cheap call and you buy a cheap put option out of the money, and create what's called an iron butterfly. So it looks like a butterfly position, but it's an iron butterfly because you're basically selling a spread on either side. Same thing with the actual strangle itself, right? So when you go ahead and do the original strangle and you're doing it undefined risk, you're just going to sell a call option above the market and a put option below the market. When you want to convert this, you're going to convert it into an iron condor by buying a cheaper put option below your short strike. And then on the top side, you're going to buy a cheaper call option above your original call short strike, right? So it creates this iron butterfly position. Now, in both cases, you're going to sacrifice a little bit of premium to do this, right? For sure. But again, you can't trade an undefined risk strategy in your account, so you've got to, basically make do with what you have, right? So sacrifice a little bit of premium for the sake of basically giving yourself a position that has defined risk, right?
So what's he talking about here, students? Did you follow this? Basically, he's saying make an iron condor, okay, which we discussed earlier on. In low risk accounts, you can't be trading too many options. So he's basically saying, this is what we talked about as an iron condor, right?
So you know exactly how much you can make, you know exactly how much you can lose, etc. So if you guys enjoy these videos, please let me know. I'd love it. And definitely.
Okay, students. So I have discussed this. We will use Opstra Edge one more time next week to look at selling and buying strangles, right? And with that, most of the option related, strategy related stuff will be finished. Then we'll look at Black-Scholes valuation, options valuation, and all those other things. Any questions, students?
No, sir.
No questions at all? Any comments, any observations?
Nothing, sir. Today's class is pretty technical, right? So I have to go through the material once.
Yeah, yeah. Options are highly technical, but that's why I am, instead of just teaching it through the traditional method, I'm actually showing you live strategies, option strategies using the Opstra Edge thing, so you can actually relate. Yeah.
Yes, sir. Yeah.
So you are able to follow along the Opstra Edge things, right?
Yeah. Yes.
Yeah. So now definitely go around and play around with the stock which has been allocated to you. You posted that in WhatsApp for everybody?
Yeah. Yes, sir. Already done that. Yeah.
Yeah. And the deadlines are also posted?
Yes, sir. Yeah.
Okay. Okay. All right. So any other questions? Anything else you want to discuss? Anything else?
So for these option trading strategy assignment also, we'll be submitting our analysis, right, along with the trades which we have done, correct?
Yeah, so basically you submit the screenshot from Opstra Edge and just discuss that.
Okay, okay, no problem. Yeah.
So that'll be the best way. If you try to manually write it down, it may confuse. It is already doing it for you. Just copy paste that into your Word document and submit it.
Okay, okay, no problem. Similar to the first assignment, right, which we're doing.
Yes, yes, very much so. Again, there are also screenshots of your strategies. The only thing is you have to explain on what basis you took those.
Right, right, yeah.
So here also on what basis? So for example, is it a bullish strategy? Is it a bearish strategy? Is it a market neutral strategy where you don't expect market volatility to be there? And you should always tie it up with probability of success. That is also, and risk reward ratio. That is also there for the options strategies.
Okay, sir. Yeah, got it.
Okay, students, then all the very best. Have a good week. See you next Saturday.
Yes, sir. Yeah.
Yeah. All right.
Okay.
Bye.
Bye.
Thank you, sir.
Bye. Have a good weekend.